Well, we saw U.S. markets briefly dip into negative territory in afternoon trading. However, back in positive territory for the moment anyway. Some interest rate sensitive stocks in particular continued to gain today following the Fed's shift in commentary. So how should you position your portfolio for a new year with a new direction, perhaps? Let's bring in Brooke Thackray, research analyst at Horizons ETF Management Canada. Thanks so much for coming in today.
Well, thank you very much.
So what did you make of the commentary from Jerome Powell yesterday? I mean, we've been about 24 hours since then, and it seems like markets have digested things and taken it pretty positively in terms of the potential for rate cuts.
Yeah, well, you saw the Federal Reserve really being hawkish for so long. The market was giving up on them and saying, well, we don't believe you anymore. Interest rates were still heading down despite Powell's hawkish tone. And then we saw that shift yesterday that took place. And the markets responded very positively. It was a much bigger shift than anybody really anticipated. It's a shift in language. Basically, we're probably not going to hike rates. We're going to, we see some room to move down. So the market said, well, this is a very positive dynamic to be bullish on the market.
So do you think that markets have priced in this, potential for these 3 rate cuts next year that the dot plot is sort of projecting at this point? I mean, more equity markets than, looking at like swaps, for instance.
Sure, of course. I think the initial, we saw that rally, a very strong rally, and today we're seeing the market sort of move around back and forth. But I think this is a positive dynamic that can really help the market in the short term over the next month or so. The fact that the Federal Reserve is at least going to lean that way. We saw the expectations move towards, hey, this is when the Federal Reserve is going to actually start cutting rates. Perhaps in March is when the expectations are now for a total of 6 rate cuts, at least from investors' perspective.
Yeah. Do you think that's possible?
I don't think so. No. I think they're being overly optimistic. If you take a look at the Federal Reserve dot plot, I'm not a big fan of that. But,
yeah. And it changes too, just as the swaps markets does as well in terms of the interpretation.
Yeah, and right now it's saying, well, there's maybe 3 rate cuts next year. So I think investors are getting ahead of themselves. I think you're going to see some damage control from Powell over the next week where he's saying, hey, look, OK, you were really bullish on this. But yes, we can still hold rates at this level. I didn't say we're cutting now type of thing.
So if we do see the sort of benefit to the broader equity markets in the first part of the year, but then these cuts start happening, when you're thinking interest rate cuts, what sort of an environment does that happen in, and what kind of impact could that end up having, though?
Yeah, that's the dangerous part, is if we start to see some rapid interest rate cuts like the investors are pricing in right now, that's bad news because they'll be cutting for a reason. Powell's just not going to all of a sudden start cutting because, hey, we can cut. He really wants to still make sure he can get to 2% and stay at 2% for inflation. And if they start cutting fast, that means the economy's in real trouble. And typically in that part of the cycle, equity markets go down. We're not there yet, and that's why I say it's positive, at least in the short to medium term here. But at some point, if we do start to see some rapid interest rate cuts next year, that's not good news.
So big picture then, what would you be doing right now if you were to be taking some, sort of action to be prepared for these next few months, the possibility for maybe some gains in the shorter term and then uncertainty?
Yeah, so it's interesting because usually the rate cuts favor the growth sectors of the market, for instance, the technology sector. But if you take a look at the performance of the technology sector over the last couple of days, it hasn't been great.
Yeah, but over the past year, I mean, it's
fantastic.
Right. So would it even continue if the environment changed in that way? I
think we might be setting up for a rotation here right now. And some of the sectors that would actually look good in this environment are one is small caps. So why small caps? Small caps, they don't have the same type of debt schedule that large caps have. So they're more beholden to higher interest rates. When rates are higher, it really hurts them much more than large caps because the duration of their debt's much shorter. And so with declining interest rates, that's going to give the small cap sector a boost. And that's exactly what we've seen over the last couple of days. So they've been beaten up for the last couple of years, very badly relative to the market. And I think we could see a pivot into small caps at this point.
Short term or longer term, do you think?
I think that could actually be longer term as well. Just because if you take a look at the valuations.
Rates would be coming down over longer term too, yeah.
Absolutely.
Sorry. And
also,
valuation side, yeah.
and the valuations, if you take a look at the valuations, the PE ratio on the S&P 500 is, around 20 or so, and then we're down to about 10 to 12 on the small caps. Much lower valuation. Sure, there might be some issues as far as delinquencies in the small caps, et cetera. They're more exposed to that, but I think we're setting up for a longer-term trend on that.
What about sectors in terms of real estate? We saw some real gains in real estate stocks yesterday and today as well. Would that be an area that you would be interested in?
So, yeah, there's no question that lower rates is going to help real estate. The danger there, though, is just like we were talking about, the Federal Reserve goes into that real cutting mode. The danger is if we start to slip into a recession and when the economy really slows down, the real estate sector could be hit. So we could see a boost in the short term. I'm a little bit worried from a longer term perspective about the economic slowdown really impacting the real estate market.
Are there other sectors that you would be looking at in particular in this environment?
Well, I think we're seeing gold respond very positively to this. And traditionally, when the Federal Reserve pauses its rate hikes, which it did back in July, what you see the gold actually do quite well. It has pulled back a little bit just recently. It's bounced back over the last couple of days, but we're really trading at all-time highs above $2,000 here, which is really good news for this. Investors have really held off on gold recently, despite some of the weakness in the U.S. dollar and also interest rates. So we're seeing that strong bounce. I think gold can actually do quite well from this level.
So would it be something that you'd be exploring right now in terms of, options within that area, that realm, or would you be just holding if you had, gold or a miner, say?
I think they're both set to do quite well. The fund I work with, we're actually invested in both gold and gold miners, and so there's some opportunity, I think, to move higher from here. So when something reaches an all-time high, that's not bad news, and that's exactly what we've seen with gold. And the magnitude of its increase relative to the decline of the U.S. dollar and the falling interest rates. Look at the interest rate on the 10-year yield. It's dropped from about 5% to below 4% today.
Yeah.
That's incredible. So I think gold could react positively to that.